Welcome to OLevels Business Studies Unit 19, Costs, Scale of Production, and Break-Even Analysis. All business activities involve costs that cannot be ignored. When planning to open a sports shoe factory, a manager must consider costs to ensure success. Understanding costs allows comparison of factory operations with revenue to determine profit or loss, aiding decision-making. Comparing costs of different locations helps in choosing the best option. Cost analysis also helps in setting product prices. Accurate cost information is essential for managers. When calculating business costs, it is crucial to differentiate between fixed and variable costs. Fixed costs do not change in the short run with sales or production and must be paid regardless of revenue. These are also called overhead costs. Variable costs change directly with sales or production. Total costs equal the sum of fixed and variable costs over a period and can be compared with revenue to assess profitability. Average cost per unit is calculated by dividing total cost by total output. Total cost can be determined by multiplying average cost per unit by total output. Classifying costs as fixed or variable helps in key decisions such as setting prices to prevent losses, determining production feasibility based on revenue and costs, and selecting the most cost-efficient business location. Economies of scale reduce average costs as a business grows, allowing larger businesses to benefit from lower costs per unit. Several types of economies of scale contribute to these cost reductions. Purchasing economies occur when businesses buy materials in bulk, lowering costs through large-scale purchasing. Marketing economies enable larger businesses to afford better marketing and transportation, reducing per-unit costs. Financial economies allow them to secure financing at lower interest rates due to their lower risk. Managerial economies arise as larger companies can hire specialized managers, improving efficiency and cutting costs. Technical economies result from investments in advanced technology and production methods that smaller firms cannot afford. However, growth can lead to diseconomies of scale, increasing costs due to poor communication, employee disengagement, and weak coordination. These factors can slow decision-making and reduce operational efficiency. Break-even is crucial for businesses, especially startups. It represents the minimum output required for total revenue to equal total costs, resulting in no profit or loss. Reaching break-even early increases survival chances, while delays lead to losses. Break-even output can be determined using charts or calculations. To create a break-even chart, fixed costs, variable costs, and revenue data are needed. Fixed costs remain constant, while variable costs change with output. Revenue is calculated by multiplying quantity sold by selling price. The break-even point occurs where total revenue equals total costs. Below this point, the business incurs losses. Above it, profits are made. Break-even charts provide a visual representation of profit or loss at different output levels, help analyze pricing and cost changes, and assess the safety margin. The sales drop before losses occur. However, they have limitations. They assume all goods are sold, ignoring unsold inventory. Fixed costs may rise with higher production, contradicting assumptions. They focus only on financial factors, overlooking market demand and competition. The straight-line approach for cost and revenue may not reflect real-world complexities. Businesses can calculate break-even production using a formula by subtracting variable costs from selling price to find contribution per unit, and dividing fixed costs by this contribution. Understanding break-even analysis helps in making informed financial decisions and achieving sustainable growth. Thanks for watching. Make sure to like, share, and subscribe for further content.